It's been more than 100 trading days since the S&P 500 experienced a pullback of 2% or more from a closing high. And since the early 1950s, that's only happened 7 other times. And 6 months later, the S&P was higher every time with a median gain of about 8%.
The chase is on. People are raising their price targets as the market keeps chugging along.
The gross margins for the average company have troughed and are going up. The Fed's ultimately going to be accommodative.
To welcome back TikTok. It's been a while, but let's we're going to check and see where we're at with the markets here. Obviously we're shooting straight up, right? Margins are expected to go higher. The fundamentals are coming into place. The macro is still pretty much in good at a good pace. We're going to talk about the Fed, where the economy's at, right? Inflation, employment, why the market is so hot, what we have going forward. Now, me personally, the video, right? In general, the concept is that we're going back to QE, and we have a lot of evidence for that. The ending of QT, right? Quantitative tightening, the end of reducing credit, and now we're starting to pump credit. We're getting closer to those rate cuts. Maybe they're not. Maybe they're this summer. Maybe not. Who knows? But we're going to listen to what Powell actually says about it. Until then, right before we get there, let's just take a look at the actual technicals. I mean, we're riding straight up. Does this not look like the early 90s? Right? The mid 90s. I think it was 95. I have a chart over here, and we're going to refer back to that because this is definitely unprecedented. Well, not unprecedented, but nobody guessed it. Nobody guessed that would be here at this point. So this is kind of what the 90s look like. Let's see if I can find it. I think I posted it up here. Let's see. Yeah, 90s, right? We talked about this I think a week and a half ago, and the whole premise was that we continue to melt up. 1995, we had a bullish pause right there in the white. You can see at the top, and the market grinded higher for an entire year, right? It didn't really give you a pullback. It didn't give that. And that's what we're looking at here. Very nostalgic, a lot of nostalgia, right? Because, it's very similar. There's new technologies coming into the market. A lot of these mega trends are starting to hit. The first rate cut we're looking at this summer, possibly. That's what the Fed's saying anyways. And the first rate cut in the 90s and 95 was actually in July. So we could, it's very similar, very reminiscent. And we're going to go back to that and check, why that is. So look at us now. We're, it's been what has it been? The first quarter is pretty much straight up. So here's where the first quarter started, and we've been grinding straight up. If you do want to see the charts I'm going to be showing on TikTok, jump over to the live on YouTube. If not, then what up, Tigger Media? What up, Doyford? Welcome back. We're working hard on some cycle stuff, but this is what we got. Hopefully you guys, ask questions, whatever you got to do. And we're going to get the show started here. Yeah, we got a lot of charts. We got some charts to get to, basically where we're at. So let's go ahead. Where do we start with? Let's go ahead and start with, QE, right? What is QE? If you're new, quantitative easing is when central banks begin to increase money supply, credit back into the system. TikTok, again, if you guys want to see, jump over to the YouTube so you can kind of see the charts here. I'm not going to show them on TikTok. I'm just going to have the price action up here for S&P pointing straight up. We will get to crypto, right? So quantitative easing is basically more credits coming into the system, and there's a net inflow of liquidity or cash or credit, right? Just like your credit card goes up. And that's what we're starting to see. So if we look at the global central banks, let's throw this chart on here. Rate cuts are increasing. This is basically you taking all the central banks in the world and how many of them are starting to cut. How many of them are cutting? Well, that number is starting to increase. We're back into the cutting cycle, right? The US, the Fed hasn't cut yet, but look what we got here. This was last week. The Swiss central bank cuts rates in a surprise move, getting ahead of global peers, right? What does that mean? They're cutting rates, and they haven't cut rates since, 2007, something like that. So they haven't cut rates for a while. And you can look into that. Go look into why the Swiss central bank is now cutting rates. They're cutting rates. Brazil is now cutting rates, right? So Brazil's cutting rates. They're cutting rates. We know China has been cutting rates for a while. So they're net inflowing money back into the global system, the global financial system. We're not just talking about the US here, even though most of the information is geared towards the US. And the question is, well, what about the Fed? Where is the Fed at? Where is the actual Fed? Well, here's the dot plot for the Fed. The Fed is projecting the same thing. We just had the Fed meeting. We didn't have it live. Obviously, I had some stuff going on. Usually we'll tackle that meeting, but nothing changed. We listened to it. Nothing really changed. We're still looking at 2 to 3 rate cuts going into, for the rest of this year. We're looking at 2 to 3 rate cuts. Nothing too different. But let's go ahead and listen to Powell and kind of what he said. These are some of the highlights to the credit, the credit cycle that we're about to see. And let's start with, the fact that they are ending QT.
You're at $95 billion of caps right now. Would that be cut about in half or something in that nature?
What we're really looking at is slowing the pace of runoff, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't made an agreement or a decision. In terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that. Fairly soon is words that we use to mean fairly soon.
All right, so fairly soon is he's saying we're going to stop the runoff in credit. We're going to start reducing the amount of cash that we're taking out. Sounds very counterintuitive, but they're going to start reducing, or it's going to inflow, it's going to be less pressure against financial markets. Okay, so here's the Fed balance sheet. This is kind of what he's talking about. It's been falling for a while since I think it started to drain in 2022. It was March of 2022, something like that, March, May. Okay, they started in May. They started to drain it in May. And so what has it been? Almost 2 years that they've been removing money from the system. Almost 2 years that credit has been leaving the system. That you're in the credit credit down cycle, if you want to say. We had a little bump last March. That was the banking crisis. That's where you really should have had the collapse. That's where you really should have had the recession. But it did not happen because they actually came in, they supported markets, they supported the financial system, and then they drained it again. So this is really what QT is: higher rates, less credit. But he's saying we're getting closer, as we just saw, we're getting closer to slowing this down. We're going to slow it down here, and that means if this thing starts to pick up, and this is what I believe markets are bidding up for, because they're saying, oh, you guys are about to start turning on the money printer, right? They already are in some sense. We're going to look at those. They already are. But, the big thing is the Fed's balance sheet, and they're now talking about that. You guys notice that. Okay. So, and what we're going to go through the rest of his comments, right? We're going to listen to the Fed here. This is important. So, here's the risk. Here's why they won't just flip the credit. They're not just going to turn it back on. They want to do it slowly. And here's Powell's explanation for that.
Liquidity is not evenly distributed in the system. And there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress. And then it would be very hard to restart, we think.
Okay, so he's basically saying, look, I know you guys think inflation is so rampant, right? It's so strong. A lot of people are saying that, but it's been coming down for 9 months. And with the come down of inflation there's a risk to the banking sector, right? And he's saying that even though there's liquidity, because let's turn on that liquidity. Let's go ahead and turn liquidity on. This is the real liquidity. This is the Fed's liquidity, net liquidity. They've been increasing liquidity since January of 2023. That was the bottom. So over a year ago, what is this, a year and a quarter ago, they started increasing liquidity. It goes up, it comes down a little bit, but it mostly has been going up. Now, what he's saying here is we're going to have to slow the balance sheet down and not turn it we're not going to just have it go straight up. We're going to have to slow down the pace of that we're selling here, right? So it might turn kind of flat. We saw this in 2015, I believe. It's going to turn kind of flat. Let's go back so we can kind of get a sense of what this looks like. Let's go back to 20. So this is a flat balance sheet. Okay, 2014, they slowed down, but they were increasing, credit into the system. Then they slowed it down. And then here's where they actually drained it, right? So the slowdown would be sideways. But right now, we're still falling, right? We're still falling. And so he wants to slow it because there's still issues in the banking sector. Liquidity might be propping up some of these sectors, but there's other sectors who are weak. And they're seeing that through sentiment, through surveys, through the SEP, the Summary of Economic Projections, which I'm going to interpret for you when it does come out. There's a lot of weakness still out there. And I think Powell's saying, hey, look, there's going to be some liquidity issues in commercial real estate. You've heard it, 20,000 times. The housing market is still weak to some degree. It's not falling apart, but there's still some weakness. So we're not going to totally turn it back on. but we do want to, and it's really confusing. Basically, they're going to make it slow. So here's what else he says. He says so there's still issues in the system, right? And I think that's why they're still saying, hey, we're going to cut rates, because we do see some issues. They're not widespread, they are small, but we might have to inject liquidity a little bit at a time. So there is a lack of liquidity. So here's the all at once.
So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Yeah, so basically, look, he's saying we're going to turn this credit system back on. We're just not going to do it quick. We're going to do it very slow. We're going to increase credit here. Now, let's move over to the slides, because here's kind of what I think, or what we're seeing here, is that they're actually increasing, liquidity or cash into the commercial banks, right? This is kind of the depository institution excess reserve. So commercial banks are going to be doing the QE for the Fed. That's what we're seeing here. This is what the chart kind of shows us, is that commercial banks are going to be the ones who do the QE coming next. And we saw this a couple weeks ago when the SLR, or the the ISDA, I don't remember what the name, the acronym is, but they're basically asking the Fed, hey, look, remove treasuries from the total leverage exposure. So basically give banks the ability to have unlimited US treasuries to lever against. And that is more liquidity back into the system. They're not going to restrict them from leveraging US treasuries. So the commercial banks cash reserves are picking up. We might not even see the Fed's balance sheet really pick up much. It might just slow down. And this is the credit cycle. But we've been seeing again that we've been seeing that they're showing us that credit's already been coming back in. So they're just doing it a whole nother way. They don't want to alert markets, because if they do, well, markets are just going to go straight up. But we have seen a recovery in markets since liquidities went up. All right, or since credit has been turning up. So here's your global credit. I like to look at this because this is all the central banks. Here's in blue. This is all the central banks, the major central banks. This is global liquidity, right? And we saw that they're cutting rates in Switzerland, Brazil. There's other central banks that are cutting rates. I think it's like 40% so far of central banks have just cut, and they're going to continue to cut, not fast, but they'll cut a little bit. They're going to start increasing flows, or the money flow back into the system. So once this gets to really start picking up, then we know there's a net positive of inflows coming into the market, right? Any questions, go ahead and let me know if you have any questions. I know it's a lot of information, but the point here is QE is back. Quantitative easing is back. And we also know from the RRP, which we're about to listen into, this is the RP, the reverse repo facility, or in other words, shadow QE, right? At this point is when liquidity started coming back into the financial system to support the banking sector, to support growth. That has not, well, it's kind of slowed down a little bit, but it will reach a zero bound. It'll reach a place maybe this summer. It'll reach a spot where there's no more, where we run out, right? We talked about this last time. But here's what, Powell is saying is that, hey, when the RP runs out, guess what? We have support. We have a plan for that, even if it does run out. And I know there's a lot of people on financial media saying, oh, well, the RP is going to run out. Well, duh. You think the Fed doesn't know that? They're just going to start pumping liquidity from another spot once this runs out.
We broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that.
Okay, so basically when this gets to zero, and I know it's going up, it's inverted. Once it gets to zero, then they're going to start turning on the Fed balance sheet to match, to basically go one for one to, okay, what do we need to get into the system, the financial system? What do we need to pump in where this left off, right? So once the RP runs out, however much more we need, we're going to go ahead and buy that on the balance sheet. This is the end of QT, right? That is the actual end of QT. I think it ended a long time ago. QT, or quantitative tightening, or restricting credit, restricting your credit line, has ended a long time ago, but it's official, maybe this summer. officially they're going to turn, credit back on. So we're going to keep our eye on this, but this might not actually pump. That's why I want to see global liquidity here in the blue, not just this. I want to see global liquidity where that heads, because we're talking the European Central Bank, we're talking the PBOC from China, we're talking the Bank of Japan, and all the other big major central banks. I want to see global liquidity turn up, right? That is the cycle that we're going to be looking at here. All right. So in response to this, let's go ahead and turn this down. In response, I'll put this on TikTok. Actually, let me just highlight this. In response, look at these cycles, right? This is why we emphasize the global credit cycle and the interest rate cycle, because the flow of money is a cyclical. It is very cyclical. And you can see the flow of money goes up, it comes down, it goes up, comes down. This is ISM business cycle against credit spreads. We're going to get into this. What is a credit spread? Sounds very confusing, blah, blah, blah. Credit spreads are basically the difference. I'm going to throw the chart up here on YouTube. And credit spreads are in blue, right? That's the blue highlight, inverted. And we have the business cycle at the bottom. Now, the business cycle turning up means stock market earnings are going to start increasing. Margins are going to increase. Growth is coming back. We're seeing GDP come back. Now, that is the economic cycle that is picking up for stocks, for crypto. We see crypto stocks continue to go higher, but there's also a credit cycle where money comes into the cycle, right? Where interest rates get lowered. We're not there yet, but credit has been coming in. Now, credit spreads are the real confidence. These are leading indicators. They're leading, right? These are real investors, speculators that are telling us, hey, look, it's easier financial conditions from here. So we're going to start bidding stocks up, the equity or the debt buying of equity. So if you look at all the equities, the S&P 500, whenever an investor buys that debt, they're saying, hey, this company is likely to not fail, right? And the credit spreads are shrinking. Look at the right-hand side. The right-hand side is, you guys can't see it on TikTok. You'd have to jump over to YouTube, but I'll explain it here. On the right-hand side, whenever these things go up, this is the top, S&P's in white. Whenever the spread, or whenever we have the arrow pointing up, that is actually the spread shrinking. Okay, it's inverted. So shrinking is when it goes up, it matches with the S&P, and then when it widens, it goes down. What is the significance of this? Well, credit spreads are how much a lender is going to add premium to lending you money. Because if financial conditions are very restrictive, if it's really hard to, if you're really, if you think somebody's going to default on a loan, you're going to charge them more. You're going to charge a premium for lending them money. So the borrowers have to pay more. They have to pay a higher premium, right? That's when they widen. A higher premium is when they widen. And you can see every time the stock market tanked, it's when credit spreads also widened, right? Okay, kind of tough concept. I'll make it easier later, but you can read this. This is on Twitter. You save it. You can read it later. But when they shrink, that's positive. That is confidence coming into the system. Financial conditions are easing, and now the credit spreads are falling because the lenders, the banks, whoever it is lending, they're saying, oh, you know what? The risk of you defaulting on your loan or the ability to pay your debt off is actually increasing. So we're going to lend you more money, or we're going to take down the premiums. We're going to reduce those premiums, and that is very positive to the market. This is another forward-looking indicator when it comes to the macro. Okay, this is real investing. These are real big investors saying, hey, you know what? Our credit spreads are down, financial conditions are easing, and that's why markets are going up. This is probably the biggest factor, one of the biggest factors to why stocks continue to climb outside of earnings, outside of everything else, because financial conditions are easier. There's not the risk of collapse. There's not the risk of banks, going under, because credit spreads are falling. Right? They're actually falling. So there's more credit into the system. There's more confidence in the system. This is just a macro way of looking at it. All right. So lower risk to markets, basically, when we look at credit spreads. And that's because, commercial bank reserves are going up. There's more liquidity, right? We keep talking about this. There is more liquidity coming in. Now, at the bottom, why is that liquidity coming in? I'm going to pick this one up because inflation in red has been dropping like a rock, and it's kind of stabilizing around 2%. I think it's going to be lower. We get PCE, I believe, on Thursday or Friday. We'll look that over. We'll make sure. We do have PCE coming in, which is the Fed's preferred inflation gauge. Now, as that ticks lower, right? We come closer to the end of the tightening cycle. This is the interest rate cycle going up, tightening financial conditions. Now we should expect it to come down. Now, does it come down this summer? Maybe, maybe not. Maybe they don't cut rates till 2025. Either way, the fact that they're not cutting rates is a direct correlation that the economy is very strong, so they don't need to cut rates. That is the cushion. They don't want to cut rates unless there's real weakness. We're not seeing it. So this is positive for stock market because margins go up, because earnings go up, because profits go up. Not for every company. You got to choose the right vehicle to invest in. But for the most part, things are getting easier, right? GDP growth is climbing. This is a perfect disinflationary. Okay, now it's not perfect because it's not super disinflationary, but inflation is coming down in the macro. GDP is rising and the Fed is about to cut rates, right? So if inflation's down, that's disinflation, right? The rate at which prices are climbing in the economy are not as fast as they were. GDP is now above that. Incomes are above that. Wage growth is above inflation. And so profits are going up and there's less inflation. That's a Goldilocks scenario, which is why markets are continuing. I'm just trying to tell you why markets are going up, right? There's a lot of reasons, but here's the macro. Here's why investing conditions or risk conditions are actually getting better. They're getting easier. That's why you're seeing IPOs explode. That's why you're seeing crypto explode. It's almost crypto summer, right? Because we're in the turning cycle. All right. Let me hit that comment and then we'll finish off here because I think we do get a pullback. I'm hoping for a pullback at some point because that'll be the optimal situation for most people if we do get a pullback at some point. I'm not done yet, TikTok. We're still looking at all this. And just so you guys know, I know this is a lot of information, but building a course, that's what I've been up to, where you guys can read this the way I read it. Think for yourself. Don't believe me. Think for yourself. Look up the evidence yourself. That's what we're building in the background. I'll go back to the S&P here. And I want to say, hey, where is the pullback? Let me go to the comment first. How was your vacation? It was good. I had family come down to visit, got a little sick, but it was good. I had some family come down. How'd you guys know I had a vacation? Did I say that somewhere? I guess I did. But yeah, I had a little vacation for, was it spring break? But anyways, getting back to it here, Veronica, we can see that the S&P is pretty vertical. Now these are the 1 month. So the blue, yellow, and red is basically we're on the weekly. Now let's go to the weekly. We should be on the weekly here. The weekly moving averages. This represents the last 1 quarter of earnings, 2 quarter of earnings, 3 quarter of earnings. So I think at some point we're coming back to this moving average on the S&P. And this is a broad way of looking at the overall market, not just any individual stock. They all have their own narratives. But if we look at the market as a whole, the S&P is due for a correction at some point. Now it's gone higher than I thought it would go. It continues, but maybe we get that correction in April. We do have taxes due in April. Some people like to sell. Maybe we just take some profits because you're going to finish Q1. Q1 is one of the strongest Q1s we've ever seen, right? But a correction will come at some point. Now, here's some of the evidence I have for that. I'm not saying we will have the correction. I thought it was going to be in late March. I said that 1,000 times, just hasn't come yet. Excuse me. But here's the positioning right now. We're over positioned on average. Whenever active managers position themselves at that 100 level or at the top, you get very over positioned. We usually get a correction. Okay, it might not be very big. It might be bigger. It might be smaller. We usually get a correction when they're over positioned because they want to take profits. I think it's going to be at the end of Q1, which is the end of March. By the end of this week. And I was wrong last time. We just kept grinding higher, but maybe it's 90 style. That's why I also keep that open. 90 style bull market where we just grind higher all year. Okay, that is very possible too. A lot of the geopolitical risks are coming down. But, again, going back to the macroeconomics of things, stocks realize that real GDP is rising. Okay. ISM new orders, which are the most forward-looking indicators in purple here, are climbing. They're almost, back above 50, which would be expansion. If we go into expansion, that means growth is accelerating. And the conference board LEIs, which is a bunch of leading indicators, is now starting to pick up. And this hasn't picked up for a while, right? The whole yield curve scenario that we're going into a deep recession did not happen. The Fed is ahead of the business cycle. The Fed is managing the business cycle. And now it just comes down to, are we going to have enough liquidity to support any type of weakness? Are we going to have enough liquidity? And we do. We see the liquidity coming down. They have a lot of cushion. So I see, this is the early cycle recovery, as I've been saying for a while, and we're still going higher. Santa Claus rally. Now we're early cycle. And it just comes down to inflation. Can we continue to see inflation fall here? So S&P, weekly moving averages, let's go ahead and take those off. And let's get down to some of these closer and we'll do the technicals, but you can see we're pretty vertical here. Now, because this is not, extremely vertical, we can just keep grinding higher here. We can continue to grind higher. You see the RSI is coiling up, and that doesn't mean we drop off. The RSI can coil up, take a small drop down or up, and then just make new highs. If we do scale back a little bit to the weekly, we can see that the RSI is still, going positive, and the 1 month RSI isn't even overbought yet. So this is a very strong bull market. I don't know how many times I got to warn people, do not be short. If I'm not going to tell you what to do, but we have a lot of these mega trends, right? As we see the price actions barely starting to break out, we have these mega trends coming into place here. I'm going to put this on the screen for a couple seconds here on YouTube, right? 3D printing, reusable rockets. I'm not really into all this stuff. Adaptive robots. I think you can gain a lot of this from Tesla or from other smaller companies. Advanced batteries, autonomous mobility. This is Kathy Wood's research, by the way. Cloud computing. AI is the biggest one, right? We have NVIDIA, you have AMD, you have Intel, you have TSM, right? You have all these chips who are supporting, who are the picks and shovels to mine artificial intelligence, to mine data, to run these algorithms. So AI is a big one, obviously. And, I think the most underappreciated trend right now is crypto, right? I think that's where it's the easiest thing. Of course, Bitcoin is up big. At the bottom there, you have cryptocurrency, smart contracts, digital wallets. Digital wallets is like Robinhood. Robinhood's exploding. So the S&P will probably continue to grind higher. More than likely, I think the probability is very high. I see it continuing to go higher, but I think we need a retracement at some point, and it won't be off of extreme fear, like something broke in the economy, but it's probably going to come from profit taking off of maybe something small. I don't know what it'll be. Now let's move over to the macro forces. We're still doing the presentation here. The macro forces, or I'm going to change the wording here for a lot of people. CCL, please. Hold on. We're almost there, Papa Cookie, almost there yet. The macro forces, I'm going to switch it to the free market forces, right? These are the free market forces that tell us or guide us to what's coming next. Okay. Now, these are also financial conditions. So what I see here is we're going to look at the dollar. We're going to take a look at the dollar here. If the dollar gets above this level, it makes the market more restrictive because daddy dollar is the world reserve currency. And if it appreciates in value, it is stealing value from other markets, right? It appreciates because people are selling into the dollar because there's a global risk. So unless and the high of the dollar was the peak of inflation. Once inflation was gone, the risk was over, the dollar came down, markets started to recover, right? We also had this blow up in September. This was before the October rally, right? Before we had the Santa Claus rally that we talked about. And, we're just building up. So I think we're building up, but we have a lot of resistance here at 105. If we get above 105, we get more restrictive. Things become more restrictive over 105. Now, if it goes fast, something bad is happening. This is giving us a signal if it goes fast. But if it moves slowly, I'm not too concerned because you have another resistance level up here because cash is paying 5%. So it's kind of attractive, right? It's pretty attractive. The dollar is attractive, especially when the Swiss is cutting rates. When other countries are cutting rates, they're devaluing their dollar in a sense, or their currency, and the dollar strengthens. So that's not bad for the US market, right? It's bad if there's a real risk here. I'm not too worried about that, but restriction is above. Restrictive territory, which means restricting asset markets, is when the dollar moves quickly to the upside. Now, if it stalls out here and stays where it's at, we're in a supportive zone. We can, we've been in the supportive zone since, let's go back November of 2023 when we had the gigantic rally. This was the big rally in the market, weak dollar, strong rally. We had a small retracement. It was at the beginning of the year and markets kept rallying. So as long as we stay under 105, markets continue to rally, right? It's not a 1-for-1. It's just a signal here. The dollar, the daddy dollar, tells us risk on or risk off. If it stays below, risk on. If it gets up, be worried about some type of risk off. And that's probably going to come with war or more geopolitical unrest. So I'm not too worried about it, but that's what we look at. The next free market force is, bond yields or bond market rates. These are interest rates for the market. We're stalling out, right? We're getting stuck here. Despite all the inflation or the sticky inflation, the market still doesn't care. It's not getting ahead of it since October 2022. This is the last for the 10-year. This is the restrictive zone. So October of 2022, we haven't gotten above that level. That tells me that that tells me that people are, not people, but investors or the bond market has already sniffed out peak inflation, right? Unless we get above this level, the bond market does not see inflation going higher. And the bond market, typically, if it goes up, right, this is interest rates. If interest rates go up, they're seeing, oh my gosh, inflation's coming back, right? So we need to sell bonds and get into whatever's inflating. Is it shelter? Well, if it's shelter going higher, then you're going to see the home buyers, right? ITB is one of the ETFs, go up. And it's been going up for a while because shelter is slowly climbing. Oil goes up, right? Whatever it is, copper right now is starting to break out. So rates are looking at inflation. If it doesn't get above this level, it doesn't see inflation really coming back materially or significantly. If we stay below, very supportive. The market can now bid off of these rates because they're valued. Stocks are valued off treasury rates or bond rates or interest rates, long-term rates. That's what this is. And as long as we stay below, what are we looking at? 4.3. We haven't been able to get above this level. We got PC on Friday. If we can't get above this level, plain and simple, the market continues to grind higher, or it gives you more tailwinds to go higher. That's what it's telling us here. Okay. So this is the free market force. We got the dollar. We don't want the dollar to go up if you're bullish. If it goes up, it tightens, restricts. And then we have rates, and rates are not really going up. They're getting stuck at this level, very supportive. Now, the bigger, issue, the more wild one is always oil. Oil is always the, the elephant. Well, I don't want to say the elephant in the room, but the wild card here is oil. Does oil spike? Because, oil is inflation. This is the biggest component to all of inflation, right? This is really the biggest, the biggest component worldwide. So oil is getting stuck at this level. What are we at? 83. But if we do get above 83, I get more concerned. I think the dollar goes up, and I think rates go up, and I think we stall a little bit. That's very, and it's not like it's out of the picture. We could see oil go up. What are some of the reasons it goes up? Geopolitical risk, the Red Sea, the Red Sea gets worse. Who knows what it is? But so far, we're not seeing that, because you would see oil spike and you'd see bond yields go up. You would see the dollar go up. Not happening yet. So keep your eye on these three free market forces, because they give us signals quicker than the economy, because they're happening in real time. They give us signals to, whether to expect risk go up, or if the market becomes more restrictive or more easy. Right now, it's still pretty easy. It's not too restrictive. And also, if oil just slowly climbs, well, that's bigger profits for energy. So I'm not too worried about that. The consumer is also pretty strong. So, not too worried. But these mega trends, definitely, where the mega trends coming from is the question. All right, what do we miss here? I think we hit everything. We do have GDP coming in, and PCE, I think this Thursday and Friday. The market is closed on Friday. Let me double check. Let's double check here. And then you can go ahead and we'll look at some individual stocks. We'll look at crypto here. Chainlink's revenue is starting to go up. So we're starting to get the DeFi summer. DeFi summer here. Okay, what do we got here? Michael Gee. Okay, good. And if you have pushback, go ahead, Michael Gee. It's actually not homie. Check oil between 2010 and 2014 went up every year. Rates went down. Well, I mean, okay, so that's that's good. I'm glad you asked that. So it's always an oil shock that gets rates up. It's always an oil shock. So let's go back. Let's go ahead and play that out. Michael Gee, you said that. What else did you say? 2010, 2014. Now, the reason why rates didn't go up in 2010, 2014 after oil went up was because the economy collapsed. So rates had to go down, right? So that was an oil shock. We actually had an oil shock in 2008. I'm happy to go over this because, I do this all the time. This was the oil shock. Oil jumped from, let me see, let's make sure you guys can see these prices. So oil jumped from 180. No, not 180. Wrong chart. It jumped from 90. So we came about 2007. We're around 90, 98. And then we jumped to 103, right? That was oil. So that was oil got up while the economy was tanking at the same time. Now I have these charts. I have a lot of these charts layered, which means, or not, I don't want to say it, which means, but I have a lot of these charts layered inside of the, how would I say this? Inside of the course. So you can see how it works, right? So once we had this oil spike, that crushed growth, Mr. Michael Gee, that crushed growth. So rates actually did rise, and then they dropped, because once oil gets to a certain point, oil companies have to lay off. Energy prices get too high for companies, so they have to lay off. Now you get a down cycle in growth, and that's why it came down. So and was inflation pretty high here? Not. So first you get rates up, and then you get rates drop. So let's put on rates. Let's just put on the 10-year. Also, this is not 2010. We're not looking at a growth scare. We're looking at an inflation scare. So that is the difference between today and 2000. Actually, I think I have it up here. I think I have it right over here. We'll just turn it on. Let's go US 10-year. Okay, US 10-year bond yields. Okay. See if we can get this on here. Okay. So again, here's your bond yield. What's your name again? Michael Gee. That was a really good comment. Just because oil rates move in tandem last 2 years doesn't mean it will. No, that is true. It doesn't mean it will, but in this regime, Michael, right? Let's use common sense here. Where we're at now is inflationary. So actually, if we go back to 2008, rates did climb, bruh. Right? Rates did climb. And I've done this research. So I kind of know. I've been doing this for the last 3 months, 6 months on correlating all the macro factors here. So rates went from 3.3 to 4.2. So they almost tightened 100 basis points before, the 2008 financial collapse. So actually, no, rates do go up when oil goes up until something breaks. That's how it works, until something breaks. So you're actually wrong there. I love to say that. You're wrong, but you're kind of right too. I do agree with you that it's not always the case, but no, rates did go up because oil is literally inflationary. It's the biggest input to all inflation in the market. So rates rose until growth collapsed. Once growth collapsed, then oil collapsed and so did rates. So that's what I'm expecting. If we do get a giant oil spike, if we do get a big oil spike, then we're going to get rates up really quick because inflation goes up. And then the economy, if gasoline's up and we start getting layoffs, you're probably going to get unemployment. And then boom, everything comes down together. So I don't know what your response is to that. I always love a good comment. Because hey, if I'm wrong about something, we can learn together. But I definitely have been looking into this for a while. Dollar form head and shoulders. What do you see for GDP on Thursday? Yeah, let's look into that. Let's see what GDP is for Thursday. Calendar, and then we'll see if Mr. Michael has any response to that. I guess not. Did you leave, bro? CCL. Okay, we'll look at CCL, bro. The printer isn't on. Rates haven't been cut. What are you about? Crypto Glenn. Well, Crypto Glenn, I'm sorry, bro. I'm sorry. I really got to answer these guys because they're misinformed. Maybe somebody learns. So actually, global liquidity has been on for a while. So, and you should be happy. If you're into crypto, you should be happy here, right? Global liquidity is in blue. Okay. Crypto Glenn, I'm talking to you. Global liquidity is in blue. This was when credit came down. This is when the money printer turned off globally, right? You can see the Fed came down too. They turned it back on here, right? So liquidity came up and then it's still draining here, but the Fed has other tools. The banking crisis happened right here. What do? They turned on the money printer on the Fed's balance sheet, and then global liquidity was already rising because crypto isn't just about the US. Crypto is about global money printing, okay? Global credit cycle. Now, here's where people missed that. Crypto Glenn, here's what you missed. Shadow liquidity, the reverse repo facility, go look into it. It was at $2 trillion. That $2 trillion has been coming into capital markets. So that is a form of QE. That's been coming into the market, CryptoGlenn.eth, for the past, I would say, what was this, 2 years almost? It really started to come in 2023. So it started to come in 2023. That's also liquidity, but this thing runs out probably by summertime. And then we're going to see the Fed balance sheet start to flatten out. But really, if you want to look at total liquidity, look at global liquidity here in blue. If you're interested, if you want to know what it is, I'll show you on TradingView, like how to look it up. But anyways, yeah, we have been, and rate cuts are happening across the world. The Swiss National Bank cut rates. China's been cutting rates. The U.S. has not cut rates yet, right? But bond yields are like rates, right? Bond yields are like rates. So if we look at bond yields here, actually, I think we just had him here. Check this out, Crypto Glenn. You're talking about Fed short rates, right? But the market prices long rates. These are long rates right here. Long rates have been coming down since October of 2023. So this is easing. Now they're kind of climbing right now. They're climbing up because what's coming up? Oil, the price of oil, which is mostly inflation. So they're almost moving 1-to-1. So you can't really say this is not a correlation. I know a couple of you guys said that, but I mean, anybody with common sense can see that oil and rates have been moving together because the issue in this cycle is inflation, right? 50-year high inflation. We haven't seen it since the 80s, since the 70s. So that's why we're seeing this, just to make it clear. And don't take it personal. I love to prove people wrong. Um, but hey, if I'm wrong about something again, I'm open to it. I just know what I know. I just know what I know. Okay. I'm not going to give a comment on something I don't understand and be confident about it. But if I understand something, I'm going to be confident about it. So the Fed ended the emergency bank funding program. So look at RRP, bro. Look at RRP. They did end the bank term funding program, but the RRP liquidity has been coming into the market. That's what you're missing. You want to see the chart that I was just on? Okay. You're probably talking about global liquidity. So if you want to look at the Fed, here, I just want to show this guy global liquidity. Okay, here's your ticker for it. See if I can find the ticker. Actually, you know what? This one's on indicators. Look up global net liquidity. You'll find it. Global net liquidity. It is the European central banks, the Fed, the PBOC, and the Bank of Japan. These are the biggest central banks. Go look at that. This is their money printing with the Fed all together. And then this is the RP, reverse repo liquidity. You can literally just type, oops, shouldn't have done that. You can literally just type in RRP on TradingView, watch RRP, and you'll see it pop up. Reverse repo. You guys can see it on YouTube. They can't really see it on TikTok, but it gives you a couple of them. Basically, just pick overnight reverse repo agreement. I'm not going to sit here and explain how it all works because that's going to be boring. But look up the RP. You just look up these. It's going to be inverted. Or it's going to be. It's not going to look like this. It's going to look upside down. But I invert it so you can see that it's moving up with markets, right? And if we even put in if we add in there the S&P. Let's add S&P. You'll see what I'm talking about. Right? So let's add in S&P equity market, and you can see pretty clearly, Mr. Forgot your name. This is a good learning moment for the audience live. You can see that the market came down right with the RP. Well, it's mostly came down because liquidity came down, but it bottomed and came up with liquidity. So you can see markets really came up, not because of rates, because what is your explanation? AI? Sure, AI and liquidity. Markets move when net inflows of liquidity come back in financial markets, not the economy. So liquidity came up, the RP is going up, right? It's all together. So, and you have earnings coming up also, and the business cycle turns up also. All correlated. It's all a bunch of cycles. So yeah, look that up. RP and then Fed net liquidity. Those are your two charts that you might want to check out. All right. So CCL, I know you've been asking for a while. Why CCL? We'll take a look at CCL here. But first, let me talk about GDP. So GDP on Thursday, because Veronica asked, GDP on Thursday. Why do I have everybody's GDP on here? All right, so GDP Thursday, and this is lagging indicator. So like I like Fed now GDP because it's like real-time GDP coming from the Fed, Veronica. Look up Atlanta Fed GDP now, and those will be the estimates for real time. But this is going to be our quarter over quarter GDP. They're expecting it to come in at 3.2, which is pretty strong for Q1. So expectation is 3.2. Honestly, I think the market's already priced in any difference because we have Fed now GDP, right? The thing about asset markets is that we have a lot more data than we did in the past. So now we can look what GDP might look like in real time, which means a lot of these are just confirming the trend. But the real time indicators or the forward, it's not really forward looking. I wouldn't call it forward looking. They're called coincident. The coincident looking indicators are really going to give you what we see, Veronica. But GDP on Friday is just going to confirm whether that is, true or not. That's all it's going to confirm. We're looking at 3.2. That's a pretty strong quarter. 3.2 is pretty strong. Regular trend is like 1 or 2%. 1.5% is like regular trend. So growth is coming in strong. And the Fed said this. The Fed said, look, GDP is stronger than we thought. Therefore, we might hold rates higher than we expected. But also, Powell is saying, hey, we might actually keep rates higher, or not keep rates higher. He's saying we're going to turn that balance sheet on, right? As soon as we think. So I think the Fed knows there's something happening in the banking sector, in real estate. So they know they're going to have to increase liquidity at some point, and probably cut rates. And they're not going to go crazy cutting. There's no threat to the economy. What they're going to do is just cut a small 25 basis point cut, right? It's not 100 basis point, just a small cut. Unless there's a black swan, then they'll have to cut a lot. So GDP looks good. I mean, honestly, none of these I don't really think are predicting too much. We're kind of out of the whole inflationary environment. Now we're at sticky inflation. But as we saw in the 90s, inflation stuck around 3% and the markets continued to climb. You're welcome. Earnings tomorrow morning. Oh, that's why you wanted to see CCL. Okay. My bad. I know. Here's CCL. CCL. Let's look at the weekly. Carnival. Is this Carnival Cruise? Man, people still buying Carnival Cruise. It looks like a good trend. I'll tell you this. What's your name, Cookie? I don't know much about Carnival Cruise. I don't really look into it. But I would listen into their guidance. Listen into their guidance, because if a lot of people are traveling, which could be the case, their earnings could go up a lot. I am not familiar with the fundamentals of Carnival Cruise though, so I don't really have much to say other than it is in an uptrend. And it looks good. I mean, it looks good, but again, you want to know the fundamentals. You want to know the business, how it's doing, what that guidance is going to be. It's starting to wedge here from the lows, so that's a good sign. That is a good sign. Let's throw on the also, hey, the ETH guy. Why do you think crypto's going up so much, bro? Why do you think crypto is so strong? Because liquidity has been rising. I've done this 1,000 times. So go look at that global liquidity. That's the main reason crypto is going up. Would you say don't apologize for being smart, do your due diligence, have an informed opinion? No, sometimes I just apologize because I come off rude because I'm just an aggressive person. So I don't mean to hurt nobody's feelings. But again, if you're gonna be a fool, then I really don't care. What's your thoughts on SoundHound? Oh, SONU. What is this? Another chip? So yeah, CCL looks good, bro. Honestly, it looks pretty good. Me personally, your support's at 1450. Listen to the guidance. Listen to the guidance. We're coming around to summertime. Maybe their guidance is up. People are planning trips. I would look that into the fundamentals to see, hey, is the guidance, are they getting what would you get? Are they getting orders coming in? I don't know how you'd say it, tickets, or people signing up for tickets for the summertime. I really don't know who's their competitors, blah, 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 whatever. But the trend is going higher. Plus liquidity is coming into the market. Earnings tomorrow morning. Okay, I see that. Got that. Also SoundHound. All right, let me go to Sound really quick. Sound, SOUN. Is this the one? Oh, this is the one that Nvidia is invested in, right? Tigger Media. It's AI audio company heavily invested by Nvidia. Okay. I'm a little skeptical of all this stuff. I mean, I think I don't know too much about the fundamentals, right? And the reason I say that is it's gonna move higher because Nvidia is investing in it, but it doesn't mean it's solid yet just because Nvidia is invested in it. So I'd look at the earnings. I would look at, what is their business, what is their reach. I don't really know this company that well. AI audio heavily invested. Whatever the market cap is, I don't know. It looks like the trend is breaking off, so it may be looking for some support. I don't really like the technicals on it. Previous support is right here. So maybe we do have some support. Let's turn this on to the weekly, make it a little thicker. All right, so here's your support on sound. Now again, Tigger Media, I don't know too much about it. I have a couple friends who are buying it because they believe, oh, if it's part of Nvidia, then it goes higher. Where I want to look a little deeper into the company to see like where they're actually at fundamentally. I haven't done that, so I can't tell. But it does look like you have support around $5. I want to see it hold 5. I want to see it bounce, hold 5. Pretty good. If it can't hold 5, I mean, that's a big drop. If it can't hold 5, I don't know. I don't know, especially with this strong market. Also, I don't know how interest rate sensitive it is either. So, there's your technicals for that. Other than that, I don't really know. Okay, back over here. What do we got? Earnings. No. On my chart, global net liquidity is going down. Okay, well, what I'm getting at here is there's another way to look at global net liquidity. I'll find it. But global net liquidity is going down at the moment. You are right. You are correct. It is coming down at the moment, but liquidity is picking up in the it's the low is in for global liquidity. The low is in. Central banks are cutting, right? Central banks are cutting. The cutting cycle's picking up. It's because you didn't see the charts I presented earlier, but the cutting cycle's picking up. In other countries, China is printing. Most people are printing money. So Europe's about to start cutting also. The Swiss central bank just cut rates. So that's a positive liquidity for the market. Now, in the short term, this does signal less liquidity, right? In the short term, it isn't a downtrend still. It's still in a downtrend. But if we use, common sense, it's going up from here, right? And also you have the RP that's been fueling liquidity also. So there's multiple ways. Now, if you measure this on a year over year basis, which I can pull up for you if you want. Let me pull it up. The year over year liquidity, global liquidity. I'll even show you how I get there on this website, except for I pay for this. So I don't expect you to do this. I go to macro. I'm going to show these guys really quick. They're asking about liquidity. And then Tigger, what did you have? But Nvidia's throwing lots of cash at AI companies. Yeah, Nvidia's throwing a lot of cash there. Let me go to this really quick so they can see. Okay. So here we are. Hopefully I'm signed in. Let's go to US. Let's dive down here. Let's go to is it Fed or is it US markets? I think it's US markets. Go here. The heck? Why isn't it letting me click? Okay, I don't know what's going on. Hold on. We're going to get to it. Oh, there we go. Got some bugs. Okay, there we go. I don't know what's going on. Is this thing having a glitch? All right. And then we go to, I'm pretty sure it's on this one. Oh, there it is. Major central banks M2 money supply year over year. Okay, so you're right. Look, it's coming down. It is coming down right now, but the trend is back up. Okay. So basically, what you need is something to change. You need something to change in the next couple months. Now, I've been saying I think liquidity is going to be pretty weak until the summertime. Then the Fed's going to start cutting rates or whatever. But the trend is back up. Typically, once you move up, you might decline a little bit, but for the cycle, what's your name? Poppy or no, crypto Glenn, for the cycle, if we look at the overall cycle, the cycle is already bottomed out, right? The cycle has bottomed out. So you'd have to explain why liquidity goes back to new lows. It's not going to happen. It's not going to happen unless inflation were to spike. But if inflation spikes and crashes the economy, boom, more liquidity. It's as simple as that. But this is the story. Liquidity has been rising for a while. Bond yields are down. That also increases liquidity. There's so many ways to look at it. Or, I just call it the credit cycle. The credit cycle is still in the early stages. But yeah, it did fall a little bit. Like it did fall starting in, what is this? Since October, it's been coming down. Yeah, I don't expect that to continue because economies are weak. So they're going to start printing again. They've already been doing it. Yeah, the FedNet is not under a symbol. It's an indicator. FedNet liquidity. Just type that in. Okay, I don't know what these guys are talking about on here. We'll go back to the thing. So yeah, liquidity is declining in the short term, but the overall trend of liquidity is going higher. I mean, oops, that's the expectation. Maybe I'm wrong. Maybe it goes lower, but I mean, with things starting to weaken and the Fed announcing, hey, look, we're going to stop draining the Fed balance sheet. I mean, that is positive liquidity going up. You also have another one. I know I keep throwing this on here, but I almost forgot about this. You can also look up the Fed net liquidity. Let's turn these off. Fed net liquidity or global liquidity. Maybe I gave you the wrong ticker. There's two of them. There's Fed net liquidity and there's global liquidity. So Fed net liquidity is up, right? And this is coming from, we put this on YouTube earlier. This is coming from commercial bank liquidity. Nope, right here. So commercial bank cash reserves have been climbing since January, right? And this is it. So this is Fed net liquidity. If you take all the US Fed's net operations, they're increasing liquidity into the system. So it goes up and down, right? I mean, it does come down, then it goes up. It comes down, it goes up. But you just think about it yourself. If the economy is very strong, they don't really need to inject much liquidity unless there's a commercial real estate or banking issue, which the Fed is projecting. They're saying it in their tone that, hey, we see some issues ahead. They're not major, but that we do see some issues where they're going to increase liquidity. And the reverse repo facility is still pumping liquidity. So it's just liquidity. It's just, it is what it is. It is what it is, right? So QE is back. QE is back. It's been back for a while. I mean, that's why markets have been up, and now it's going to restart the other the actual confirmation probably this summer. I mean, Powell's never going to say liquidity QE is back. He's not going to say that. Markets react way before the Fed actually says anything, right? Markets, for example, okay, for example, Bitcoin peaked, okay, and I'm a crypto guy. Bitcoin peaked literally right after the Fed. This is when the Fed announced in 2021 that they would be increasing rates. They didn't actually increase rates until March, but they announced it here and the market started to sell off. Okay. So markets react before Powell makes his actual decision. So what do you think is going to happen on the flip side? Before he actually eases, markets are going to rise because they're expecting the ease. Markets price in data, or they price in expectations about 12 months before those expectations actually come, right? That's what markets do. Plus, you got to take in consideration fiscal policy. That's fiscal dominance. They've been pumping a lot of earnings into the market, right? The Inflation Reduction Act, the CHIPS Act, the infrastructure bill. All of you who've been here with me for a while know we've been talking about this all through 2022, that there would be a turnaround because of all the fiscal policy, which is fiscal stimulus or fiscal liquidity, right? You can't measure all these things because if it was that simple, on a chart, it feels like, and you can find the charts to it, but you don't really need to go find the chart. You know they're going to print money. These are just things, in markets price in futures. They don't price in right now. Okay, let's see. Yeah, I wouldn't. Sorry, him. Not you. Let me see. Is oil not going up? Oil is climbing. Yeah. Oil is climbing. Oil is climbing, and I would say if oil gets to a very concerned level, then if it gets to a concerning level, you just get bond yields continue to climb with oil. We'd expect that Fed, blah, blah, blah. Okay, so there's no QE, just hopium. No, QE is coming. Q is coming. Also, there's a lot of stuff in the banking sector. What is it called? Basel III. There's a lot of stuff in Basel III that is telling us that the banks are basically going to be the QEers from here on forward. The banks are going to do the QE, not the Fed. I would look into it yourself. Look into Basel III, the new changes. The article from ISDA. I can't remember what the acronym stands for, but basically the leverage requirements are going to take out US Treasuries. So they don't want to restrict banks from leveraging on US Treasuries, which means more QE. They're going to go through the banks, right? Now, I don't expect you to understand that right off the bat. I'm not saying I'm so smart, but I do take the time to do the research and understand how it works, and then just try to report it. But yeah, go look at it for yourself. Go look up the SLR agreement from or the changes that are going towards the Fed, so they can do QE in some other way. And really, just to make it clear, guys, the QE I'm talking about, right? The real QE from the Fed's balance sheet, that is not here today, but it is coming. The Fed just said that. He said in the last meeting that they're going to slow down the balance sheet. But if you look in reality, liquidity's been climbing for a while. QE's been on. Okay, QE has been going up, global liquidity, and the reverse repo has been shadow QE. This thing has been moving up the entire time. So go look into this. Go look into the reverse repo liquidity, how that is a QE. You can change the terminology. It doesn't matter because the net behavior, right? The net action is liquidity into markets. That is QE. That is QE. Net liquidity coming back into markets. That is QE. Right? You can dress it how you want, but it's going higher. All right. Well, no, Joey, I don't expect you to understand it right off the bat. I'm telling you to go do your own research. I didn't understand this when I first saw it. I did a lot of research. So don't get offended, bro, just by my tone. Liz, if you're gonna get offended, this is not for you. This stream is not for you if you're gonna get offended. But yeah, go look it up for yourself. So yeah, the Fed's going to continue shrinking the balance sheet, but they're going to slow down the pace. Okay, you tell me what's next. They slow down the pace, and then they what? And then they make it. The pace stops, and then here comes QE. Plus, it's already happening. But the real concept here is that markets are already pricing this in. Markets have been pricing this in for a while. So you can take it, do the research yourself or not. Basel III, banks are in trouble. Yeah, they are. Unless banks will be in trouble, but here's what they're doing for Basel III. They're not restricting treasuries. They're trying to change that where they don't restrict them from holding treasuries, bro. So that means they can still leverage up with US treasuries. Check that out. Go read into that. Okay. Yeah, but yeah, please don't get offended. Oh my goodness. This is just, hey, go look it up for yourself. And then you can come back and be like, hey, look, I didn't see it. Or actually, I read this. I'm open to that. Okay, Joey. All right, cool. I mean, we can go live on it then. We can go live. You want to go live? I mean, I think we're done here on YouTube unless you guys wanted to see some other charts. I always love a good debate. Let me see. Do you have the followers, Mr. What's your name? Joey? Oh, you don't have the followers. I was going to say, I would be happy to have that debate or discussion about QE. Yeah, I'd be happy to do that. Anyway, back to it. Yeah, markets are pricing in QE, bro. Like it's plain. Like quantitative easing is a made up term they made up in 2008, right? To actually balance out markets and liquidity and credit. But at the end of the day, if the net flow of money is rising from the central banks, that is QE. They're not going to say that because they don't tell you exactly what's happening, right? They said during the inflation, when inflation was climbing in 2021, Powell said we're not even thinking about cutting rates. But what do? Increasing rates. What do? They turned around and they hiked rates. So it's not what they say. You got to look at the data. You got to think about what they're trying to manage here for the most part. And so, yeah, the RRP is the real QE. It's been the shadow QE for a while. All right. So, let's see, what else do we have? Oh, you know what? Also, check this out. I don't know if any of you on YouTube we had talked about cooler technology for a while. Oops. And it did get a pretty big bump here. So I just wanted to inform you on that. I did say we'd keep up with that. And this is like a super micro cap stock. I'll get back to you guys on TikTok. This is like come on. What is this? Puzzle. Why do I got to do a puzzle? This is like a super micro cap that we've been looking at for a while because it's part of energy. It's part of the battery revolution or energy storage. And it finally popped because they announced a couple of contracts. I'll go ahead and look it up I have it on my Twitter, but they are increasing contracts. They were in trouble for a while. I was like, hey, this is a super risky play. So I'm going to pull that up. While I pull that up on Twitter, let's see if we have any more go live. Let's see. Yeah, I would go live with them, but I don't think he can go live yet. So, but either way, yeah, Joey, if you know what the RRP is, then you know that liquidity has been coming into the market. It's QE. It's basic QE. Dress it up how you want. All right, so here it is. So yeah, you guys see that big bump in the price, right? And look, this is not financial advice. I just wanted to give an update. It's very small. The market cap was like 26 million. Or no, it got down to like 20 million. Super small. And I like the narrative. Okay, it fits inside of the mega trends. I don't think it's going to be a $1 trillion company, but it does fit inside the mega trends. Fits inside of what fiscal policy is going to support, or what technologies governments will support. They're the number one, battery, our service provider for NASA for their batteries, in space. Now they're doing services for the Army, and that's what we're going to look up right now. Cooler technology. All right, and this is just their Twitter. You guys can look it up for yourself. So I think the first one was, and a lot of these announcements just came in March. Okay, Voyager space. So a lot of this space, a lot of stuff that's going on in space, they're just providing services. Specialized space battery enhancement. I mean, it's really complicated what they do. I don't understand it to 100% T, but I do know their revenue is climbing pretty quickly, and they just needed some more contracts. They need more contracts. They have a contract with battery testing for one of the US automakers. I don't think they said who it was yet, but they are now contracted with some US automakers. EVs are the future, even though they aren't today across the world. They're still, that's where we're headed, right? That's where we're headed. That's what investing is about. Not what today, but where are we headed to? What is the future value of this investment? Okay. Also they they increased their or they have a contract from the US Army now. You can look more into it if you want. I'm not going to do the full deep dive, but they're getting contracts, and that's what boosted the stock, is that they are now. Lockheed Martin, Cooler is collaborating with Lockheed Martin. So if you get more, war, unfortunately, or whatever it is, that's going to be good for Cooler. You don't want to see that, but it's just battery technology in general. So the stock finally exploded. It's up a lot. And I don't really I'm not going to say you should invest in it or anything, but that is one of the micro caps I've been, eyeing out for a while. Shout out to Dimaj. He's been helping me out do the research a little bit. So he's in there also. All right. NVIDIA. And then obviously Chainlink. Chainlink has a lot more partners that they're announcing also. All right. What do we got back here? I'm still looking over these charts you've got there. Let's see. Dharma Kid. Hey, thank you, Dharma Kid. Appreciate it. Oh, this is your first time, Crypto Glenn. Look, Crypto Glenn, we're both crypto guys, bro. We're both crypto guys. We might not see all, the same. I'll just tell you what I learn. I mean, I do this pretty much full time as I look at the macro 24/7, and I'll just give you my short bit for crypto. Is if the dollar rolls over, that's positive for crypto. If interest rates roll over, that's positive for crypto. If liquidity keeps picking up, that's positive for crypto. If interest rates get cut, that's positive for crypto. Crypto is mainly, other than the supply shock of Bitcoin that's coming, crypto moves most, just like gold, when the anticipation of QE or quantitative easing, or the credit cycle is starting to pick up, or interest rates are coming down. Anytime things get easier, there's more money injected into the system, crypto goes bananas. So, that's all I'm trying to show you here. I have so many correlations with it, 24/7. Dharma Kid can tell you. And I'm not saying you can't question me. I love to get challenged. I love to be questioned. That's good, right? Never believe what somebody just says. Go do your own research. So go check those out. But please don't get offended if you guys are on here. And I'm not saying you are. Just don't get offended, because this is just how I do things. All right. See what else we're gonna look at. All right, yeah, some other technicals here. Oh, you know what? It was copper, yeah. So here's another. I don't know how big of a threat this is, but copper is starting to move up. It broke out of this trend, and copper is a proxy for the cost of infrastructure. As oil is the cost of energy, copper is the cost of infrastructure. So this tells you that economies are starting to pick up, but if copper, rips higher really fast, that's going to put upward pressure on inflation unless they can produce more copper at a faster pace, right? But I really doubt that can happen without more liquidity and lower rates. So I'm anticipating that sometime around summer, so we're in March, April, May, and also the US Treasury, their debt issuance runs out, or they're done issuing debt. I think in May. I think they're done issuing debt in May, which means there's going to be less upwards pressure on interest rates. Okay, so I think it's all going to come down to this summer. Once we get around to the summer, June, July, I think asset markets really start to rip again. We might be in a consolidation period for a while, depending on what you're looking at. I mean, if you're looking at Nvidia, they have their own. This has its own narrative, so it really doesn't care about 5% interest rates. It really can care less, because the earnings are growing so quickly. So, but for the overall market in general, when you get global breadth, or a wideness of asset prices moving up, I think that starts in June, and we'll see where inflation's at. You do need PCE to come down. You still need inflation to come down for sure, and I think the Fed's pretty much done. And this is the cycle. I think inflation really does start to tip back over. Where did I put it at? No, that's why I have it zoomed in. I think it really starts to tip over maybe in, because look at their trend here. Like, this is the actual CPI. I know people get all crazy about, oh, inflation is so sticky, but look, it bumps up, comes down, bumps up, comes down. I mean, the trend is still lower. And if this trend is still lower, then that means interest rates, we're getting closer to the interest rate cutting cycle. So risk assets are going to outperform everything else when the interest rate cutting cycle begins, given there's no recession, and also given that liquidity is picking up, which it has been. Now, you can say QE isn't here, but I will say this, fine, go ahead and make it QE is not here, but liquidity has been. Liquidity has been turning up, which is why we showed that other chart where on a year-over-year basis, if you look at all the money supplies across the biggest major central banks on a year-over-year basis, which is a momentum trend indicator, it's been climbing. Now, the past couple of months, it's been flat, but it has been climbing, right? Oh, yeah. The YouTube is where all the charts are at usually. That's usually where I have all the charts. Glenn does this on a regular. Okay. Okay, Glenn. I see you, Glenn. That's what's up. And then let's look at some price then. Let's look at some price action here. What do we got? An hour 14. All right. So let's look at some price action here. I know nobody's really talking about Tesla, but I really still like Tesla. I think Tesla is setting up. And I say that all the time, but the last time we ended the Tesla trade was when it could not get above one. I think it was like right here. Watch, we'll dive in a little deeper. It couldn't get above 189. This is why I don't really tell people how to trade at all, because it's way too quick, right? Only thing I'm saying is to leverage in, Tesla's one of the mega trends, right? It's going to provide into the future labor force through robots. It's not here yet. And also full self-driving is only getting better. They have the most data. They have, giant AI, not here yet, but it will be, right? You're investing into the future. And I think it's very mispriced. People will disagree with me. That's totally fine. I'm just giving my upside. Once we got this gap down and then we dropped, I'm pretty sure this was the trend. 189, 189.50, right? This little bump higher, I was out. And we had been buying it, right? From the lows. We got this reverse head and shoulders, got into it, and then this was the stop right here. This was the stop. Then we got a gap down right after that. So we gapped down right after that. But now what I'm seeing here form is another reverse head and shoulders. We just broke out of it. So reverse head and shoulders. And it's sloppy. It's not like the perfect, reverse head and shoulders, but it did break out of that. Now it's coming back to retest. Hopefully it can hold. I would say it needs to hold about 170. Maybe it holds about 170, but it is getting close to breaking out of this trend. And we'll only know over the next couple of weeks. Now, I wouldn't be too optimistic because we're kind of going. I think April, we can see some weakness. The longer the market continues to grind up, I think the closer you're going to get to a correction. Now, is it going to be a vicious, long correction? I don't know. Maybe it's really quick. Maybe it's just a quick, pullback, and then we rip forward. Like if we look at the cues, what we've been seeing is, come on. If we look at the cues, what we've been seeing on any correction, it's been like a sharp pull down, right? It's been like a sharp correction to the downside, a couple sharp corrections, and then it bounces. And I'm using anchored VWAP, which is volume weighted average on each correction to see if we're going to hold that. So this past correction, we held it, we moved higher, we held it, right? So I put another one here. We've been holding that also. Actually, no, we've been leaking below it. My bad. We've been leaking below it. We're above it right now. So I'm using the volume weighted averages. If we go all the way back to this past pullback or this past correction, these are all small. They're not really corrections. A correction is going to be probably like 5%. We haven't seen that yet. Now it's a big possibility going into April. April is going to mark Q2. Okay, so cyclically, or what do they say? On a cyclical basis, you go quarter to quarter, you might have some fund managers who have to take profits going into Q2. So this would be my next guess when we get the correction, if we do break this trend. And if we do, maybe we come back to 420 on the Qs. If you're looking at SPY, let's not do SPX. I don't like to say 5,524. Let's just do SPY. We're still above that anchored VWAP also. So we could come back to 512 and remain in the uptrend. It is looking good. You see some gaps too. Well, it's all your time horizon, right? It's all your crypto Glenn. It's probably your time horizon. Like in the short term, the trend is still very bullish. The trend is, look at this. I mean, yeah, it's straight up, right? 90 style. It looks like the 90s. And there's a great possibility we don't get a correction, just like we did not get a correction in the 90s. So that's still in the cards for sure. As long as we hold this anchor VWAP, as long as we trend higher, as long as oil doesn't really spike, as long as the dollar doesn't spike in interest rates, the probability of us grinding up, it continues to increase for sure. The probability just increases while you get a rotation between, I think consumer discretionary today got a pretty good bid. As a matter of fact, how is Amazon doing? Because their AI is coming in. Like Amazon still just has that sloppy grind higher, but there's just a lot of themes in the market. Now you're getting IPOs. I think it was Reddit today. Let me go to the in play. I think it was Reddit. When you get IPOs launching off, that's another sign that markets are strong. You get IPOs actually coming in and bidding up. There's a lot of liquidity, a lot of cash on the sideline. So if we do get a pullback, I think it's going to be healthier for the long run for the markets because there's so much cash on the sideline and there's not really a whole lot of leverage. According to FINRA margin debt, there's not a whole lot of leverage in the market. So a pullback would attract a lot of those longs who just never got long, who have been waiting for a while. So I think it's healthier if we get a pullback. If we don't, we just grind higher, right? And then the Fed cuts rates, maybe nothing happens because cutting rates isn't bearish. What's bearish is economic activity turning negative. That's usually when they cut rates. We've been over this 1,000 times, right? Typically, rate cuts are bearish, but this time you have liquidity or you have credit coming into the cycle, coming into the market at the same time, which means there is no recession coming. Also fiscal, fiscal liquidity coming in. So there is no recession. So even though we have high rates, there's too much liquidity. There's too much support for capital markets to really see a recession, which is why everybody's been wrong. Most people have been wrong about, oh my God, we're going to go into this deep recession. Unemployment might get to 4.1. It might get up to 4.1, but you also have record level of immigration coming in. Let's not get political here, but baby boomers, check this out. I saw this fact today. 11,500 people turn 65 a day. 11,500 people turn 65. So they're heading into retirement. Our labor force is falling without immigration. So we're getting immigration is partly why the markets are also have been pretty stable, because all those jobs that where you can lower where you can basically build for less, right? Build for less, cost cutting, that's also helping. So there's a lot of dynamics coming in here. It's not just one thing. It's not just the Fed. It's not just earnings. It's not just consumer debt. It's a bunch of things. And when you add them all up, markets should definitely be higher. But I'm still looking for that correction at some point. Not a big one. Okay, not a big one, but I'm looking at a correction at some point. And it's also possible, I put this out yesterday, that Bitcoin, the halving already priced in, because that's already what, next month? The halving already priced in, and we could be consolidating sideways for a while. Maybe you think otherwise, crypto Glenn. You've probably done a lot of analysis on this, but it looks like Bitcoin might move sideways. It could come back down to 52,000. I mean, I don't know. Nobody really knows, but I am looking at the RSI, right? Let's go to the RSI on the daily. Okay. RSI daily, and it's getting a little stuck down here. It's getting a little stuck. So we're almost at new highs, but the RSI, the buying pressure is much lower, which tells me if we don't break out of this RSI, if we don't move higher quickly in the next week or two, we could get a bigger correction down to 5,200. This is not a for sure. I'm just throwing out the probabilities. I think the probability is climbing at this point. Okay, now it is kind of weird for Bitcoin. Like, you never really know. This looks super bullish. Looks like we're just going to keep taking off here on the weekly RSI. And if we go to the monthly, right, the monthly typically when it breaks out, it has a small little pullback. We had this back in 2017. And I'd say this cycle looks more like 2017 than it did the last cycle. Because the last cycle we had the pandemic that kind of ruined everything, right? We tried to move higher, then we had to come back. But this cycle was just went straight up. And I think that's what we're looking at, a cycle where we just go straight up. But, a small correction, you can't even see that on the monthly. You're not even going to be able to see that. So possibly coming back down here. Just to look out for it. Now, if you're already long, I wouldn't do anything. I'll just chill. We're at a descending. Okay. Yeah, sure. Descending channel. Ascending channels make me nervous. Yeah, me too, Crypto Glenn. That's why I'm saying for the S&P, I think, and I know I'm kind of late to your comment, but for the S&P, I'm expecting that correction at some point. I think it comes April because people are going to want to take profits. There could be some kind of like in October. You guys remember, if you're with me, I found that, and I don't know everything. I searched through a lot of research and a lot of people's opinions, and I try to put it to the test. In October, October of 20, look, I might even have this chart up here. I think I saved it. Check this out. I did save it. If you're on YouTube, you'll see it. If you're on TikTok, you're not going to see it. But these are calendar cycles. So the calendar to the rescue. So typically October is the bear market killer. And I was like, why is it though? Why is October usually the end of the bear market killer? And orange is the S&P. And the blue line is the average going back 50 years. It's the average performance of the S&P. Now, it usually ends in October. What I found out was mutual funds end their tax loss harvesting in October. So once that ended, which is a calendar year, then they can start buying back. And that was, I mean, I'm not saying that's why. Nobody knows exactly why, but that did correlate. It made sense. So what I'm thinking is going into April, there's going to be some type of calendar change or switch where fund managers might have to deleverage. And we also see this, right? If you're on YouTube, you'll be able to see it. You can also see that, and I put this chart up today. Active managers, the positioning is at 100%. So they're fully invested. You guys can't see it here. Active managers are fully invested. Now, that doesn't mean we need to see a pullback, but whenever you do say, okay, active managers are fully invested, and SPX, let's go to SPX, and SPX is just climbing, just climbing higher, right, for this whole quarter. So the yellow is Q2. Well, I think the probability rises that you see a correction at some point. I mean, we're in the straight channel. Okay. I don't know what it's going to be. Okay. People sit there and tell you, I know what it is. I don't know, but I'll tell you this. If the dollar, the free market forces, if they start to rise, they're going to restrict the investment cycle. They're going to restrict basically the conditions of the market. Oil goes higher, that's the cost of energy goes up. Dollar goes higher, the cost of risk goes up. If yields go higher, that's the cost of borrowing money goes up. I think if those go up in a Q2, plus you get tax payments, I think people are going to collect profits. I think we do get the correction. Maybe we come down to like 5,000. I don't know. But the macro is very strong, so I don't think we get a bear market, right? I don't know if we go all the way back to all-time highs, previous all-time highs. I don't know about that. You'd have to have something bad because earnings are picking up, margins are expanding. But this is kind of what I'm looking at. I'm going to see how things, play out when we go into Q2. I want to see how things play out going into Q2. So back to Bitcoin. As Bitcoin rises, it's less correlated with the S&P. So really, I don't really look at the two super correlated, maybe on the downside. You never know with this, but I definitely like Bitcoin. I think it's going to be the last good risk reward if we do come back here. But yeah, ascending channels aren't that great, and they can't retire. Okay, let's see. Thoughts on Reddit for tomorrow? I don't know, dude. Reddit might be a meme. I mean, what is it? Trump's new. Is this Trump's thing? I wasn't sure. I couldn't find it. Is this Trump's Truth Social right here? Somebody tell me. I'm not sure. What is it? DJT? I think it is Donald Trump or Donald. What is it, Donald Jr. Trump or something? Well, either way, these might turn into some memes. These might just go higher, right? Reddit. So the IPO market is strong. I don't really have anything about Reddit. I'm not going to talk about Reddit because I don't have an edge. I'm not really paying too much attention to this. I mean, if it breaks over 73, it probably goes higher, right? You got to have some technical analysis on this and know the narrative. It looks like it's in a descending triangle or a wedge. You could either say this is a wedge or it's a descending pattern. So I would like chop it up like this. I mean, I really don't know. I think it's still kind of early, but and then you want to look at the flows, like where the inflows coming in at. You might have some support down here. So Reddit could come down to 55. I don't know. Maybe it comes down to 55. Maybe it breaks out. I really don't know. I'm not going to make those guesses right now. I just tell you the levels. Maybe the next level is about 61, somewhere around here, 61. We'll see. I don't have too many thoughts on Reddit though. DJT, too early. What are we doing? What's the strategy? How do I get in? Depends on what you're talking about, Mr. Something. I don't know. Depends on what you're talking about. How to get in what? Look, I'm gonna say this. I'm gonna go to this. I think my favorite thing right now. Okay, there's a mega trends going on, right? There's some mega trends. Technology is changing. I like Palantir. Okay, I like Palantir as the best pure AI play. And this, if you're trading, I'm not really going over trading, more so investing because it's way easier to just sit there. And it's a lot easier for most people to just sit there and buy support on pullbacks with the strong market, with the strong macro. And you just sit there and do nothing. Sometimes doing nothing is the best thing you can do. Now, I want Palantir. I'm not fully sizing this, so I wish it came back down here to 17, 18. I don't know if it happens. But Palantir, this is one of my top picks. It's been my top pick since I wrote about it in 2020, right? So, I mean, I've been super bullish on Palantir. And I've lost money in Palantir. So it's not like I'm not, I've lost money here and there. I actually lost a lot of money in Palantir, making a mistake. But I like Palantir. I think it's up a little too much still. To just dive in. I would never say just dive in. I think it's up a lot though. It's been holding this anchor VWAP. And if this is the trend, it's either going to support this trend and take off, or it's going to break back down here, back down to 18. If it comes back to 18, I mean, it's a blind buy for me. It's a blind. I mean, I'm probably going to get leap calls, 2026 leap calls. Don't really care because I believe in this because I've done the homework on it. Very low debt, climbing tremendously. I mean, revenue is going to increase. I like Palantir, right? As a trade though, I don't know if you're trading it. That's a different case there. If you're trading it, you're probably looking at, let's go to that 30-minute chart. It looks like it's bottoming out here if you're trading it. And once you get above what 25.50 Palantir is kind of tough. Once you get above 25.50, it looks like it can take off. Clear resistance. Let's take this off. Very clear resistance at 25.50 for Palantir, right? So above 25.50, if it holds, probably goes higher. I'm hoping it breaks down to 18. That would be ideal because I want to hold it. I'm not really trading right now, building content, and I'm riding the crypto wave, right? Crypto, you don't want to trade crypto unless you're an expert. If you're not an expert, just ride the wave. Oh, what leap calls am I thinking about? XRP, I'm not a fan of. I'll look at XRP, but I think XRP has lost its narrative. I think it's lost its narrative. What do I think about Spot? Let me take a real quick look at Spot, and then I'm gonna go to. I think Spotify is going to be solid as a long term. I don't really look at Spotify very often. That's hard to get in, man. That's tough. It's hard to get in Spotify because it's just vertical. Now, I would say if it ever comes back to this trend, then you might be good. If you can get Spotify back to this trend, it might be good. Hey, jump over to YouTube if you want to see the charts better. Like you're only seeing a little bit of the charts here. It's a lot better on YouTube. Go subscribe because you should. Because you no, I'm just kidding. If you think I bring you value, then subscribe and give me a like. Help me out a little bit. If not, that's fine. I enjoy doing this anyway. So yeah, Spotify. I mean, it's in a trend. You can see clearly it's just up. Gets above this trend. It'd be ideal to get down here to come back into the trend. So I like Spotify as a long term. I think it's only going to get better, but I don't know too much about the fundamentals. I haven't looked into the revenue growth, the margin growth. I don't know what the balance sheet looks like. I don't know how much debt they have. I don't know too much about it. So that's all I can tell you is the technicals on Spotify. Oh, you made a G on spot. Okay. Yeah, I'd wait till it comes back down. Can I look at Wild? WLD? What is this? What is this? Oh, is this emerging market play? Is that what that is? It looks like MSCI World. This might be a world emerging market play, huh? This is what everybody's talking about? Huh. Please tell me what this is first. It looks good. I mean, it's up a little too much for me. I wouldn't be buying this. But this might be emerging market play. Because global liquidity is picking up. I'll say it again. It's picking up. And either way, the cycle for liquidity to come in is just getting started. The cycle is just getting started. I mean, this thing is vertical. I don't know if it gives you a really good chance here. Let's see. I would like to see a pullback. Okay, so this is just like the S&P. This blue line represents the last quarter of earnings. Okay, last 12 weeks. All right, I see you on let me see what you guys are saying there. Check out the Trump company. I know my mom's all into it. She's all I got my mom in a Bitcoin and she loves Trump. And she's Mexican. She loves Trump. The Mexicans love Trump. And she's all, "Hey, how do I move my money over to buy this thing?" I was like, "Mom, do not do that. Like that is straight to the poorhouse." But it might soar. It might go higher just because it's a meme, right? We're going into an election. This thing our DJT might really blow up, but I don't believe in it. It's not going to take over Twitter and Reddit and Facebook. Heck no, it's not going to get that big, but the thing can run. Either way, I just thought that was a funny story because a lot of people will just buy into it just because of Trump, having no clue about the fundamentals or whether they can really make money or not. But the price might go up. But yeah, Wild. I mean, it's moving up. It's not giving you a really good entry. Whatever this is, I don't know what this is. It looks like the overall market. Whatever it is strong. Yeah, it's pretty strong. I'm guessing, and two, what you would have to do is look at what it's composed of. I can't look at it right now because I'm not going to do that. But if this is an ETF, what is in this ETF? What is it holding? That's what you want to see. What is it holding? That'll tell you why it's moving up so much. All right, what else we got here? I still like AMD. I think AMD, if the chip cycle continues, look at AMD. I mean, AMD, I remember AMD back here. I was like, this thing is going to burst. No, not back here. It was over here. I missed it, of course. I missed it right here. But AMD is also setting up. It could be reversing a little bit. I mean, this probably has to come down a bit. AMD is wild, but I would be looking for this trend. Like when it comes to AMD, you don't want to chase it because it's a hard stock to really get into. But if it ever comes back to this uptrend, which is the previous high around 140, and it can do that and just rip higher, I mean, it's probably in the top 5 for best chips. She said it would be bigger than Facebook. Yeah, my mom said that True Social will be bigger than Facebook. Hilarious. My mom's funny. But hey, if she believes that, how many people are going to buy it, right? It's probably going to be a nice trade for a while. How often am I live? I haven't been, just put the notification on. I haven't been live that often because I'm building a course, a macro course that basically the macro course is about this, and I haven't talked about it yet, or today. How to look at the credit cycle, right? First off, the economy, if you're new, like how to read the economy, what is it? The flow of money, right? When is it? Because a lot of investment cycles are like 3 to 4 years. And there's a flow of money that happens. Lowering rates increases money supply. Increasing rates decreases money. Except for in this cycle, you're getting paid 5%. So rich people still had more money. So it's really interesting. Either way, there's a flow of money. There's a credit cycle. There's an interest rate cycle. Then there's the fiscal cycle that happens every 4 years. Usually the strongest stock market is in the 4th year of an election cycle and in the 1st year. Why? Because you get all these promises, all this stimulus, and then in the first quarter, they start actually, increasing that stimulus. But usually the 2nd and 3rd year are kind of sloppy. So when you put these cycles together, you have a better picture of the macro. You have a better picture of it. Also, I'm going to teach you how to look at forward-looking indicators, lagging indicators, what they mean, and how to read the economy, right? Employment, GDP, ISM new orders, all that stuff. And then there's some other stuff in there too, like how the dollar works, the free market forces, bond yields, what do they do, blah, blah. A lot of stuff, energy shocks, XYZ. So that's what I'm working on now. I'm not live that much. I'm going to try to be doing lives at least once or twice during the week. But my brother, he's having a baby, so I might be in and out, right? Got to go support the fam. And then, but I'm building that course for you guys. Hopefully it's ready by the end of April. The whole course where it does fundamentals and technicals. I'm not there yet. That's going to take a while, but the macro I think is the most important piece because most people are misled, and it's better for you to think, to be able to learn and think for yourself. To be able to think for yourself, right? Don't just believe what people say, be able to think, look up the data yourself. TSM. Okay. Everybody's like, man, we don't care. Just tell me what to buy, right? This is TSM. Is this TSM? Yo, TSM is monstrous. I live in Phoenix, and they're building a gigantic plant over here. And this is basically to protect or hedge against if China were to invade Taiwan. They're building a giant plant in Phoenix. The only issue with Phoenix is the water supply isn't very good. So, there's not a big water supply. So that's going to be probably build this. TSM looks good. It looks good. I would like to see some more consolidation, right? Maybe back into this. Is this the weekly chart? Yeah. Maybe back into this area right here, which is like the last support. So maybe if it comes down here, it'd be good. And maybe you get something like, it's always a maybe because we don't know. The markets change every day. But a good setup would be like, hey, it starts to consolidate like this, and then it starts to pick up again, holds that level. That'd be good as long as it holds this level. So TSM looks good. Yeah, join the Discord. Let me see. Get a hold of me. Send me a message. I'll send you the Discord if you guys are interested. Wait. Oh, this guy's late. Fed started QE again. No, Sim. Basically, I'm trying to trick you. No, I'm just kidding. No, what I'm saying is QE's already been here, and now the Fed is signaling that QE is basically like markets look ahead. If you wait for the Fed to actually turn on QE, it's too late. It's already too late. Markets are up monstrously if you wait. So the only time that you wait for the Fed to actually do QE is when there's a crisis. And I think people get confused with this. When there's an actual economic crisis like the pandemic, well, duh, you wait for QE because there is no economy. But right now, the economy is already here. The economy's been driving prices higher. Liquidity has been coming into the market to prevent that. So we've already been in QE. They're talking about stopping the balance sheet runoff or slowing it down. Look at slowing. When you slow down the drain of credit, you're essentially putting money into the future, because if markets are anticipating $90 billion of less value every month, and all of a sudden you bring that down to 50 billion, well, now they can expect a net positive of money, right? I know it doesn't sound that great because you're still taking money out the markets, but for markets, there's so much liquidity already in the market waiting to come in or waiting to find a vehicle, that when you tell the market, hey, look, we're going to start shaving that off, well, guess what? All the excess money that they were saving or waiting for to protect themselves, now they can deploy it. So net liquidity is going up. Okay. I would go follow the newsletter. It's free. Go sign up to my newsletter. Link in the description. I forgot to put it on YouTube, but the link is in the description on TikTok. And I basically, every 2-3 weeks, I'll give you a little report on what I'm seeing in the market, what has changed, the business cycle, the credit cycle, the rate cycle, some technicals, kind of what we're seeing here, right? So go check that out. But the big ball game is when the course is ready. Because once the course is ready, everybody that's confused, like, what is he talking about? Where does he get all this? You'll be able to learn exactly what I'm looking at. And then you can, kind of follow along as we start doing more lives into the future. So that's my game plan, TSM. Now I'm going to talk about Chainlink. What has it been? 145? Like, it's been a while. Let's go to Chainlink because this is still, I think, great. My favorite opportunity in the entire market. So if you're wondering, well, what is this guy doing? Look, crypto in this cycle will perform the best for a lot of reasons. I'm not going to go over. Dang, Chainlink climbed quickly already, but I do like Chainlink. I know everybody wants to know price targets right off the bat. Okay, I think it moves anywhere between 100 and 150 this cycle. Very good chance it goes to 200. Not financial advice, but I do like Chainlink. They have the most partnerships. Okay, they're partnering with Swift. They're partnering with DTCC. Go look up who they are. They're the biggest depository trust clearing corporation in the world. They're basically part of the Federal Reserve. All of DeFi doesn't work without Chainlink because they do price feeds, they do oracles. So when Ethereum goes up, when DeFi goes up, Chainlink goes up, the revenues go up. Now we're starting to see Chainlink's revenues start to pick up. Their revenues were up 180% in the month of March. So what I'm saying, basically, this is the last chance before you get a good risk reward. Chainlink is going to boom. Okay. Is it for sure? No, nobody knows. But from me, from what everything I know, and if you trust me, if you don't trust me, great. You don't have to trust me. But from my expectation, I expect this thing to outperform. I hope it chases down Solana. I just think the long-term value is much higher than Solana because we're connecting all, global, we're connecting all blockchains. Crypto doesn't work. People don't know this. Blockchains can't even talk to each other without an oracle. The number one oracle by far is Chainlink. It's not even close. It is a monopoly in itself, right? Now, once the revenues pick up, the outlook is here. You're getting revenues from DeFi, from crypto. You're getting revenues from Swift, right? And they do 4 quadrillion transactions a year. So once that comes on the main net for Swift, it's over. It's game over. It is game over. Tokenization of all real world assets, right, only happens if you can communicate from blockchain to blockchain, and that is Chainlink. That is the infrastructure that's going to underline this whole process, right? That's what I believe. You don't have to believe it, but that's what I believe. And I'm betting on it big. Also, ARK, yeah, that's right. ARK is so Chainlink has been the first connector to the real world already. ARK, their ETF, is now on the blockchain using, is it CCIP or is it proof of reserves? Proof of reserves, which proves and audits in real time. So they're already using, we're already getting real usage from Chainlink onto the real blockchain. Would you say Link is juiced in? Do you like Ondo BlockRock partnership looking to issue tokens and T-bills? Link is juiced in. Oh, okay. I see what you're saying. You think everything's already priced in. I see what you're saying. That's fair enough. I don't think so, but that's fair enough. And if you want to know some other projects I'm interested in, I mean, obviously Solana is a beast, but my bet is against Solana. But Solana is a monster. That thing did not stop running, but Solana is competing against Ethereum, and I just don't think in the long term Solana can outpace Ethereum. So I'm not taking that risk. I'm not saying Solana is not a good bet at all. I mean, one of my favorite guys is, he's in Solana. I just disagree. We don't agree about everything. Somebody said XRP. I think XRP is trash. Sorry to break your feelings. It hasn't even broken the highs from 2017, right? XRP is stuck. XRP has the curse. Okay, it has the curse. It just can't go up because the narrative is lost. Everybody thought that you'd build blockchains on XRP when really the traditional financial system, they're building their own blockchains. They're not building on the the public infrastructure. They're building private blockchains. They're not using XRP. They're using their own blockchains, and what they need is something to connect those blockchains, and that is CCIP, which is Chainlink. So I'm much more bullish on Chainlink from a fundamentals point of view. All right. I like the graph too. The graph's really good. Everybody thinks this is AI. It's not AI. Don't get tricked. I also like Aave. This thing came down to, wait, where did it come down to? Oh, it came down to 105 the last couple of weeks. I wanted to really get some, but I was like, we'll wait. But Aave, I like Aave's lending and borrowing. Still pretty small. But yeah. So that's all I want to talk about. I think we're done here. What do you trade? I'm not trading right now. If anything, it'll be a Tesla. Usually, I like to trade Tesla. Am I doing a macro trade or a day trade? I am not day trading right now. No day trades for me. Not yet. Not yet. But swing trading, I like AMD. Anyways, I think I'm done here. Appreciate it. Just stay tuned for the course, the macro course, so that you can think for yourself and not have to believe everybody. And maybe it'll benefit you. So you can identify, when the flow of money increases and when it decreases, and you don't get caught in the noise. Do not get caught in the noise. All this bearishness is a bunch of noise. Long term, this market is going much higher. And we've been saying this for a while. And when the top comes, look, I'm going to be using the forward looking indicators to tip talk Bitcoin and crypto, to TikTok it, to tip it, to top it. I'm probably not going to top it though, because nobody can. But last cycle, I think we got out at 4,000 Ethereum and 59,000 Bitcoin. So it wasn't the very top, but based on these indicators, and this time we really know what we're looking at. So just stay tuned. Either way, thanks for listening. Thanks for challenging me. I always welcome pushback. Don't get your feelings hurt. I appreciate you guys. Stay blessed. Work out, eat healthy, improve yourself every day, get better. And if I had one story to wrap it up, okay, if I were to wrap everything up today, because I know people are just getting here, I would say that we're still in the early momentum cycle. GDP is still climbing. ISM new orders are barely turning positive. That is the most forward-looking indicator of the business cycle. And I think we're just getting started here. You better pray for a correction in crypto. You better be praying for a big correction if you're not in. All right. Thank you guys. Stay blessed. We'll catch you next time.